Drew Meredith, how you going?
That's my new pseudonym.
Yeah, doctor.
Very well. Yourself?
I'm pretty good.
Yeah.
Pretty good. Latest in interest rates, buy, hold, sell.
A sell, I expect them to go down again at some point in the future. I no longer predict. Last time I predicted it, we're nearing Easter here, and it was a very close call that we did get a rate cut in February. The next move is definitely down. I'm not putting any framework around when that move happens.
Okay, so it's down.
Yep, at some point.
Prices are down.
Down.
Says
we don't
Coles.
talk about grocery retailers anyway.
Okay, quick question for you. What's the best business model you've ever come across and why? That's my first question.
A quick one. So we actually, you put your notes in here, and I think it's actually very similar. You've said, I'm not going to put your answer in.
Okay.
Funds management, but probably from the year 2000 until the year 2020. Maybe it's less relevant now. Maybe there is an opportunity in there now. But what you're looking at for in a business model is high profit margins. Mm-hmm. Sticky demand. So, you could have high profit margins and buy BHP but your demand is cyclical as a cyclical company.
Yep.
And I think when I say, the two early 2010s and 2000s, so funds management is a very scalable business because the more money you get,
yep.
You do have to add more staff and you do have to a point, but you could easily you could go from $1 billion under management to $10 billion under management and probably still do it with 20 people. Like the 10-fold increase in your assets doesn't require you to have 10-fold more people, and people are the biggest cost of most businesses. So the scalability that comes from funds management, I think that has been challenged. And this is what we've talked about, you read about all the time, that when there's outsized profit margins, competition comes in. So naturally competition came in. ETFs have become incredibly popular. They're incredibly low cost. They're taking money away from active funds management. And then advisors are executing their own portfolios and also taking margin away from fund managers as well now. So very similar idea on that. And then the other one, can I have two?
Yeah, go for it. Okay.
I think we've gone down a very similar stream here. I mean, you said one, I'll say GQG or something like that.
GQG.
Apple.
Okay. Why Apple then?
I mean, it was one of the worst businesses for a while, and I think it almost failed twice. But
Microsoft
Apple,
saved it.
Yeah, exactly. No, don't preempt it.
And then then Microsoft sold their shares of Apple.
Yeah,
because they were worried about antitrust rules.
But basically, you are owning this ecosystem and then leading with they've found an ability to lead with the consumer. So look at us.
We got
both got the Apple Watch. We've both got the Apple iPhone. We've both got a MacBook in front of us.
Yeah.
You're starting to own the ecosystem, and everyone was worried Samsung would come in or Android products would overtake. Yes, they overtook, but the lion's share of profit still goes to Apple.
Yeah.
So owning the ecosystem, and then you're just trying things and adding things around it. It's not easy to build an ecosystem from scratch.
Yeah. It went from hardware to software. It's probably always been software, but they monetized hardware first. And now they've gone back to software being the predominant growth driver. Yeah, so that's interesting. I'm glad you added the context around funds management, because for people that aren't familiar or in the finance industry, you probably don't see it a lot. You probably think that like software companies are like infinitely scalable, but funds management, which is where it doesn't matter, like you said, if you have $10 million invested with you or 10 billion, you can still run that same investment portfolio if you're a funds management business. And the profit margins are like almost infinitely scalable. I think it's pretty hard to go past like Google and Facebook, but I won't say those because like they basically turned the most important asset in human history, which is the internet, like digital communications, and said, we're the portal for the world. So they're like pretty powerful companies. When I said antitrust, by the way, before, it was Microsoft actually saved Apple to avoid antitrust. So what they did was they invested in Apple to say, no, don't worry, regulators. There is a genuine competitor. The name is Apple. So they saved their competitor.
Old colourful computers we used to get.
Saved their competitor in order to say there was competition.
Yeah.
But then they sold the shares later on, which is crazy.
10 wealthiest people in the world.
So my two companies are pretty much, similar to yours. So I've gone with, in Australia, so one of the downsides, just before I get to the name, one of the downsides of funds management is typically the best funds management businesses. Like if we go in Australian history, you might have Platinum, Magellan, GQG more recently. The problem with them is they're often associated with like one talisman, like one head investor, the founder, or they even have like two different funds. Like Magellan had the global fund and the infrastructure funds. And what happens is if those two things change, like if the fund itself doesn't perform as well, or if the CEO quits or something like that, the whole thing can come tumbling down.
We've seen that.
But what actually has happened with a company called Pinnacle Investment Management here in Australia, it trades under the ticker symbol PNI, is Pinnacle have what they call an affiliate model. So they take an equity ownership of other funds management businesses and they say, you guys, you do the investing, do it really well, we'll be your backbone. We'll do everything else. You guys just be really good investors. We'll own some of your company and we'll do your marketing. We'll do your compliance. We'll do your everything. You guys just worry about the investing. And they've obviously now got a fantastic track record where fund managers want to be part of their network because it means they can bolt in and get more capital for their businesses just by being part of Pinnacle's network. But effectively what it means now is, I don't know exactly how many affiliates they've got off the top of my head. But
16.
But say if they had 10 or 20 affiliates, what they call affiliates, which are other funds management businesses, it's effectively an investment company that invests in other investment companies, but it has major shareholdings in them. Some of the fund managers who have appeared on this show over the years are Pinnacle affiliates.
18.
And the key thing with Pinnacle is its business model is if one of those affiliates goes down, it's still got the other 17 to go. And they're all really good. They make good profit margins, huge amounts of cash flow, like huge amounts. And crucially, if you're listening to this in 2025, Pinnacle is now investing into the UK and US. I don't know if it will be a huge success, but it's a fantastic business model nonetheless. Finally, Microsoft is the one I've gone with other than Apple. Microsoft has always kind of been software first, whereas Apple was hardware first. Still have the software, which is amazing, but the software of Microsoft, I've kind of like lampooned Microsoft products in the office. I think James O'Reilly.
He's Googling everything.
James O'Reilly from Retirement Podcast with you, Drew. He brings it. I noticed he brings a Microsoft product into the office. I think Gemma still does as well too. Anyway,
you can have Apple and use Microsoft. Best of both worlds.
Can you? Anyway,
I think I've just checked on AI as you do. Is it Gemini? Is that the one that works on Google? I don't know their names. I try not to get too personal with them.
Yep.
GQG's profit margin, operating margin is 77%. Their net profit margin is 57%.
So how many businesses have a net profit margin after all of the cost of goods sold,
businesses
after paying the electricity, after paying the admin staff, after paying the employees, after paying for the licenses? How many businesses really have a profit margin of 56% or whatever you just said?
The computer can't compute, but not many.
Computer says no.
Says no.
Microsoft is the one I've gone with because...
gross margin, yes, not net margin.
Oh, right, okay.
Yeah.
The thing is with Microsoft, people forget that for 13 years, its share price went basically backwards and sideways. 13 years. So... like Satya Nadella has basically come in and been a huge proponent of the cloud and now AI and has done some amazing things. But it's a wonderful business. You know your business has reached kind of apex when the government gives up on doing its own thing and it just says, Microsoft, can you do it for us?
Can you do the Pentagon security data centers?
Can you handle the pension system for us? Can you do our everything? And like when you log into a secure government database here in Australia, you get the security code from Microsoft.
I just stumbled onto something I put in the show notes, but basically NYU Stern has a list of the average margins by sector. Okay. So net margin, I just dropped it in there.
Yeah.
The two high, like you can just quickly, there's like 50 different sectors. The two that you can clearly see are financial services and investment management.
Wow, this is cool, man.
I just found it by accident, and that's only the first. I think it's on the first page.
Wow.
But then computer services peripheries come in shortly after that.
Wow, this is really cool.
Yeah, so I just randomly stumbled on that, and you can see. So gross margin is your gross profit. So before you start extracting all the operating costs,
tax and that sort of stuff as well. Yeah. Well, yeah, financial services average net margin, if I'm interpreting this data correctly, is 22%.
Yeah.
That's huge. Investment management, 18%.
Non-bank and insurance.
Oil and gas, if you're in production, is 20%.
Yeah.
REITs, yuck.
The difference is you have,
Semiconductors, 20%.
like Macquarie Group, you have a
Here's one, Drew, for you. Okay, you can't look at the data. What would be the average net profit margin of tobacco companies?
net margin, like 70%.
32%.
32%. Yeah, outside of tobacco, financial services.
Outside of vices, the anti-ethical companies, they're probably the good ones. So
I thought that was interesting.
Interesting. Here's an absolute shocker of an industry for you. Consumer electronics average
That's
profit
set me
margin
up well
of
for the next question.
15%.
It's all about scale.
Outliers.
Rubber and tires also struggling. Precious metals.
Wow. Okay, next question.
Green and renewable energy.
If you could only invest in one ASX company and one US company, what would you buy and why?
I'm going to go with two.
Okay.
This was, and I actually had a fairly similar one to you, but I'll let you have that. And this doesn't work well considering we just talked about net margins. ResMed, as an ASX listed company, so the provider of sleep, not just sleep apnea, but basically sleep health and breathing apparati. Very high market share, very scalable, similar to Cochlear, but hasn't had the issues of It has had issues at different points.
Yep.
And the key there is there's a growing market, there's an undiagnosed market, and both continue to grow. And then the second one I probably should have just left out, JB Hi-Fi.
But no, it's a wonderful business.
Always admired that business, and every time they try something new, everyone poo-poos it. Can I say?
Yeah, you can say
poo-poo.
MA15 plus warning.
We're not going to get explicit content.
Gosh, imagine.
But JB Hi-Fi, like I remember, I'm going to do this too often now.
Yeah.
They walk in and they haven't changed. The JB Hi-Fi stores hasn't changed. Originally, it was a property play, and it's all about margin. They fought off Amazon. They've basically fought off all these providers and still going strong and expanded into whole different areas.
Gross margins for JB. This is gross margins. So this is the top of the income statement.
8%.
22%.
Oh, that's
2%. Yeah. Net margin, 5%.
Yeah. But that's, so your net margin's low, but you have a massive volume. That's what you want.
Wow. It's actually absolutely unbelievable business. So since 2002, it was 140 million of revenue. Now it does 6.4 billion. It'll probably do 140 in a week.
Who thought a company that basically started doing discount CDs out of a garage would go from $2 to $92?
I remember I've looked at this company basically every year since 2010 thinking it's not going to do well.
It's expensive.
It's kind of like ARB, which has the bull bars.
And then it's doubled since September 2023.
Wow. That's a good business. Okay, I'll go Aussie. Soul Patts, which is Washington H. Soul Pattinson. Someone once asked me on Twitter, if you could only buy one company and walk away for 20 years, I would be like, well, what company's going to survive 20 years? Would be one that can respond and be agile, and that's Soul Pattinson for me. It's run by the Milner family and Todd Barlow, CEO. I've had on the show, all of them. So it does everything. It's a diversified investment company. It's got its own investments. It runs companies. It buys private companies. It buys big chunks of public companies. So I'd say Soul Patts, and it's a pretty boring answer for most people, but I just want to know that what I could buy, it would still be here. And I think you could choose an index fund as well, but I actually think that I would prefer, if you gave me 20 years or 30 years, I would rather invest with a human at the helm than an index fund, because I just don't know what's going to happen in 20 or 30 years specifically. But at least I know if there's a family that's passing on good habits and values, I feel like that's anti-fragile, in my opinion. What about for US?
I actually was going to have two for this, but we're pretty boring here. And I have to double down on my everything portfolio holding.
Yes, your portfolio that we started at the beginning of the year. Yep.
And stick with NVIDIA.
Yep.
Not giving up now.
It does corn chips, right?
Yeah. It's really big corn, like with the biggest corn chip.
Biggest corn chip maker.
Yeah.
I hear people
significant
in Holland.
player.
Yeah.
I just can't see, like, if you could only own one company in the next 20 years, are we going to see any slowdown unless there's some sort of catastrophic? I'm not sure if anyone's watching the TV show Paradise at the moment.
Oh, yeah.
Even that relies on maybe less NVIDIA chips. But unless it's that case, it's where, the share price in the short term may be overdone, might not be overdone. I'm not making a call on either.
Yep.
But the demand and the lead they have on chips is
Yeah.
as far as I can tell, unassailable.
Yes.
So I'd be comfortable sitting on that, not just for 3 months, but for 10 years.
Okay. Yeah, I like it.
Boring.
No. I think it's good. And I think the growth is definitely there to justify the valuation. This next one's going to seem silly because it's probably too expensive. So I don't know if I'd buy it today, but I've talked about it a bit recently, which is Costco. I just think it's a fantastic, absolutely wonderful business. In a similar vein, I'd probably go with Berkshire Hathaway, which is, even though if we took a 10 or 20 year view, regrettably, like Mr. Buffett is quite old, so he may not be in charge of Berkshire for forever. Well, that's the truth. But, I think what Costco's done really well, again, is it comes back to the succession planning. The current CEO was a forklift driver who's worked for the company for decades. I think when he took the helm, I could be mistaken, so someone can write in and correct me on this, but I think when he took the CEO role, he took the CEO role at half the pay of his predecessor, which is just speaks to the value of the company and the culture and the ethics and not ethics, but just the culture that they have as a business. And Costco's business is actually just a membership subscription business. It's got extreme customer loyalty. It makes money by selling memberships, not by selling products. The products just get people in to buy the membership. So it's quite an interesting business model. And that's what I think makes it really anti-fragile, sorry. And I'm really, if you gave me a 5-year view, I would go with yours. I would go with NVIDIA, not Costco.
Yeah.
Because I think that NVIDIA's got more growth.
Costco's more like JB Hi-Fi.
Yeah, it's just going to keep, you kind of do have to spend more time on your valuations and things like that with Costco than you probably do with NVIDIA, because the growth kind of heals the wounds of overpaying, so to speak. So we've got time for some quick questions here on the Australian Investors Podcast. If you do want to send your question in, head to your podcast player or in your YouTube description. The thing that says ask a question, select the Australian Investors Podcast. We answer questions here every week on the show, and we love to hear from you. So send them in. And if you get your question on the show, you will get a free enrollment or a free course, which is the Value Investor Program. It teaches you everything you need to know about investing. It's usually $499 Australian dollars, but it's yours for free if you just write into us once your question is read out. Stock Sultan did write in and said, I think Stock Sultan's been around a few times. I'm almost ready to begin investing, and I'm trying to figure out if it would be better for tax reasons to start out investing in dividend ETFs like the Vanguard VHY ETF compared to an all-growth ETF. I feel like a dividend investing would help grow your investment using a dividend reinvestment plan faster than, say, dollar cost averaging. I'll come back to this in just a second, but before we answer it, remember that any of the questions on the show and the answers that we give are strictly general in nature. We don't know your needs, goals, or objectives, so be sure to speak to a financial planner before you act on the information that we deliver on this program or any Rask podcast. So dividend ETFs, let's just go with that. Dividend ETFs or investing for growth? Do you have a view?
I mean, you got to look at your time frame, obviously, but I think it's the data is pretty clear that shows that investing in companies focused on paying out large portions of their profit as dividends to shareholders are they just grow less. Like the data is clear, the facts are clear. And you're talking about a completely different range of companies. So if you're in a VHY, you're buying a whole heap of mining companies and oil and gas companies. If you invest in IVV, you're buying a whole heap of technology and consumer-facing companies. I know if I'm investing for growth, which portion I prefer, and income is basically the capital coming out from that company, and then you're putting it back in to the company, which seems... Ultimately, you probably want to do a combination of both, not one or the other, and I think that's always a consideration. Where does this sit within a diversified portfolio? But yeah, I think, and there's the question around DRP and dollar cost averaging into the portfolio. I think that's more the cart. Did you say cart leading the horse more than anything? So is your objective to grow?
Yeah.
Then you're not going to get more growth investing into high dividend paying companies than if you're investing into growth-oriented companies.
It's interesting, Drew, that you say about the dividend investing versus growth investing, because as one of your golden rules at Water Partners is the total return.
Yeah.
Growth plus income equals total return, which is what everyone should focus on. One of the reasons that the Australian stock market has outperformed basically every other stock market over 100 years is actually because of our dividend policy.
Yeah.
But it's a quirk. It's not because we pay a lot of dividends here in Australia. It's because of the franking credits, which is basically a tax.
Extra 1.5%.
Yeah, every year. And that's what leads us to have the best returns overall. And I think there's a lesson here in that if you are a tax-effective investor, you'll probably do better. I don't think that necessarily means everyone should be going for dividend straight out of the gate. I think that's sometimes a mistake. I agree with you there. But I just think that you can focus on both, and at different times of your life you should. I think we recommend the VHY ETF, or we use the VHY ETF in our retirement portfolios just because it's got 75 of the dividend-paying stocks in Australia. But it does turn over the portfolio, so meaning that it does buy and sell a bit more than, say, like an ASX 200 or ASX 300 ETF. So if you're in retirement with the zero tax, again, I think just being
a little bit of a free kick. Yeah.
Tax mindful. Another question comes from Pete Rabbit. Best way to manage a large amount of cash. Would you put it all in stocks or grow it through a savings account? What would be the best option that is most tax effective? So here's someone asking about tax effectiveness. Well, shares are definitely over the long term. I think, what was it? Buffett's quote was, in the short term, stocks are risky. In the long term, they're risky not to invest in. And the longer you zoom out, the less risky shares become. What do you think?
Yeah, I mean, it's all about your investment horizon and your time frame, isn't it? I'm always concerned what would be the most tax effective. You've got entity structures you can choose from. Let's not let the investment decision be dominated by the tax decision.
Yep.
So whenever someone comes in like this, it's basically, is there any need for that cash? I need it for a home deposit. I need it to, renovations. Well, yeah, let's put it into government guaranteed term deposits or a series of lower risk investments that mean I know it's going to be there when I need it.
Yep.
If not, then let's invest into shares. Let's invest into go for growth or go for an income and growth. And then it's a matter of what does your situation look like? Do you have significant income? Is it worth setting up something like a family trust or a proprietary PTY Ltd company, or are you nearing retirement and you could put this money into super and invest it there? So separating the tax question from the investment question, I think, is the first step. And I've seen too many times the tax tail wagging the dog.
Yep.
And it ends up in people find incredibly tax effective investments that have no investment value.
Yep.
That's what I'm always worried about.
Yeah, and then some of the best tax-effective vehicles like investment bonds, or as they're commonly called, or superannuation, have massive drawbacks.
Yeah.
In that it might be super tax-effective, but you can't access your money till you're 65. So if you're not going to be accessing it soon, it may not even help you reach any of your goals. Like, we speak to a lot of people that want to retire early before 65.
Yeah.
But they can't because all their money's in super because they chose the most tax-effective vehicle at the time. That's a good question, though. The next one is, yes, if a call is required. Don't know where that one comes from.
I think it must be a question on your sheet.
It must be when they send some questions.
Provide your number. Yes, if a call is required.
Okay. Chess sponsorship, they say, does it matter? On your recommendation, I have downloaded a couple of apps to see which ones I like more. I'm leaning towards BetaShares Direct and CMC Markets, or CMC Invest. One is Chess sponsored, which is CMC, but BetaShares Direct is not. Both apps seem good. As a beginner, I will be investing monthly, so low brokerage fees are important. Just not sure if Chess is an important consideration. So just for people's clarification, the Chess system is unique to Australia. It basically means that when you buy shares on a Chess sponsored platform, your unique name and identifier is held at the stock exchange.
Yeah.
Versus a custodial model, which is a different model where...
It's how the US works.
Yeah, which is how the rest of the world works, which is where your money goes into a company, and then the company has its own, effectively, register internally. But there's still like multiple forms of regulation on top of that.
Platforms in Australia work with custodians similar to the US.
Yeah, so it doesn't matter, do you think? Because you guys use Hub, you guys use NetWealth, you guys use CFS Edge.
I think even under a custodial agreement in Australia, you still have a Chess registration.
It's at the custodian level, I'm pretty sure.
Yeah, but it's in the custodian with the name of the client usually within it. Yeah. Which is I think different to like a non-Chess sponsorship.
Yeah.
Most of the time this is fine, but what you saw during the pandemic were some of these trading platforms that were pulling essentially using the one HIN and making money by selling your orders to other people. Yeah. So it's the old saying is, if you're, I've forgotten the saying now.
While you think of that, my old colleagues.
You're the product.
If you look around the table, and you can't
If
figure out who the
something-
patsy is, you're
Yeah.
the patsy.
And if it's something's free, you're usually the product.
Yeah.
So just being careful of that you're not just going for the lowest cost, but you're still getting security, and you're talking about pretty like established and financially
like
secure
Beatishes is a
companies.
massive company.
You shouldn't be worried about them falling
Yeah.
over, but it's more about what control do you have if things change.
Yeah, and for sure, seek out like reputable brands that you can verify they have a financial services license on the ASIC website and those types of things. To be honest, I prefer CHESS sponsorship. I think it's fine to have like a reputable brand like BetaShares Direct. Full disclosure, BetaShares sponsor our finance podcast, or even NetWealth or Hub, or most of those platforms are custodial models. I think just use what's best for you. The big difference between the two is that if they were to collapse, one is easier
to get
your money out. It's that you should still get your money out of the other one, but one is easier because if the way CHESS sponsorship works, which is the same way our platform works, is that if we were to go bust, you could just take your number, your particular holder identification number, and go to a different broker and go, hey, this is my number. Can you bring all the shares across? And it wouldn't matter if we were broke. The shares would go straight across.
Yeah.
Whereas with the custodial model, you'd have to wait for an administrator. They'd have to release the funds.
Yeah.
And it just might be a delay. I hope that answers someone's question. Final question comes from Kayla. It's a bit of property v shares debate. At this stage, would you rather keep a $400,000 investment property? And they do add some good context. It's a 2-bedroom unit in Melbourne's inner north.
Because this is going to help us.
No mortgage, growing at 2% per year, or sell it and invest in the share market, which may offer more consistent, stronger growth. 400k investment property. You don't get many 400k investment properties these days.
You got to,
Not even in Melbourne.
Here it's like, I'm probably in an apartment and I'm guessing Fitzroy, Collingwood.
Yeah.
Lovely areas. I'm a north side. Yep.
You're a north side guy. I'm an east side guy.
Shout out to those in the north.
Yep.
Northeast. Nor'easters. We've got to stop laughing so much. This is the question. And as a financial advisor, I'm not going to tell people their property is not going to grow. I have no idea whether that property is going to grow or not. You got to look at this in the context of your overall situation. Mm-hmm. There's one you can look at it straight on the investment merits, and then one you can look at it in your overall situation. In a lot of cases, people are holding on to properties in the hope of growth, and last few years have seen that it doesn't always come. It doesn't go up 10% every year.
Yep.
And then you have to think about the opportunity cost, or would the equity you've got there be better off helping you to fund a passive income? But straight on investments, you could get an income of probably 2% after costs, if you're lucky.
Yeah.
And it's been growing by 2 to 3, but there's no guarantee of growth in the future. At the very least, you could be getting 4% buying the ASX 200 tomorrow
with dividends
plus franking credit. So you've doubled and yes, there's no certainty on those dividends, but 4% is pretty consistently the amount of income you get from the ASX.
Yeah.
And to add to that, you're not buying a depreciating asset. You're buying a pool of 200.
If you buy an index fund of the ASX.
Innovative, and not that we just do that, but you're buying companies that are evolving. BHP's, investing more money. CBA's evolving. They're, adding digital. Like, you're buying all these companies. Some are going backwards, some are going forwards. Whereas in the other case, you got one asset, you got one tenant, and you've got one input basically into the success. So I'm hoping I get a lot of but feedback on that. But I just find property. But it's worked, and I wish I owned more property 20 years ago. But now it just seems very difficult to justify.
I would say, based on the numbers that have been thrown around here, that this is either an apartment or a unit. It probably wouldn't even be a unit, let's be honest. So if that's the case, the data suggests that apartments are nowhere near as high performing as houses. Obviously, houses come with a much higher price tag, so standalone dwellings. The thing about, if Drew has a CBA share and I have a CBA share, they're exactly the same. They're what we call a commodity. They're effectively exactly the same. You can trade them, and one is the same as the other. But property is not fungible. So this $400,000 investment property could have beautiful views of the park. No building's going to be put up in front of it, and it could grow really well because it's the only one that has the view of the park. But if you get another one, like where I was out east, in inner east with Hawthorne, and you have an apartment building, it could be a great apartment, but 10 minutes later, there's one getting knocked up next door, and all of a sudden your apartment is worth less because the brand new one's just gone up. And what we find over time is that investment properties, particularly apartments, are less valuable over time. I don't necessarily think it's one or the other. So you got to understand what the asset is that you own and why you own it. I think you can have a property that goes up in value and use that tax effectively to buy shares. If you don't know what I'm talking about, you should speak to a financial planner who can talk to you about concepts like debt recycling or equity release, and use your property tax effectively to get more shares than you would by just buying the shares with cash, as in just saving up money and buying shares with cash. This is what we do. Spoke about it in a recent episode, how I withdrew money from our primary place of residence, and we can now use that money for whatever we want. Drew, we can't let you go without your dad joke. Before you get to that, you can reach out for financial planning advice. There is a link in your podcast player or in the YouTube description. Just select the one that says financial planning and you're good to go. There's also one there for mortgage broking if you do need one of those at the moment. Drew, give us your dad joke.
This fits in with our opening as well, I think.
Okay.
What do you call the security guards for Samsung?
What's that?
Guardians of the Galaxy.
Now, I was privileged to this question, to this joke beforehand, and I think it is excellent. Guardians of the Galaxy. For those of you like me that are on iOS or Apple, Galaxy.
You wouldn't get it.
Yeah, don't worry. Don't worry, guys.
There'll be one for you next week.
Yeah, there's another one. But Drew, this has been heaps of fun. To get in contact with Drew, head to wattlepartners.com.au. Mr. Meredith /Derrimouth. I hope you have a wonderful weekend. Thank you for joining me.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.